All right, welcome back, everybody. We hope you enjoyed that first introduction. In this video, we're going to talk a little bit about how to simplify your profit and loss statement. And we also want to just give you a suggestion on how you can structure your profit and loss statement so that it's really much more meaningful and useful to you as a business owner, so you can really understand what some of the numbers are telling you. Then we'll get into a sample and walk our way through that. So let's just start, really, what is a profit and loss statement? Well, you may have also heard this called an income statement, and it's a really simple report that you can generate out of your financial software that essentially says we have a revenue or we have income that comes into the business, and in order to generate that revenue or that income, we've had to incur some expenses. So those expenses now are applied against that revenue, and what's left over are profits, or in some cases, losses if we tend to spend more than we bring in. So in its most simplistic form, a profit and loss statement simply says, here's what's coming into the practice, here's what's going out of the practice, and what's left over is either a profit or a loss. So here it is. It's a report that shows us if we made money or not. That's really kind of what we want to know. It tells us about our revenue, our expenses, something called our gross profit, which is the amount of money that's left over after we apply our cost of goods, so our frames and lenses and contact lenses. And what's left at the bottom is our net operating income. It'll also give us some idea about growth trends. It'll let us compare year over year if our revenue is going up or down. It'll help us understand if our expenses are going up or down. But it doesn't tell us anything about how much cash we have. Sometimes a profit and loss statement gets confused with a cash flow statement. And so it's important to understand that there are a couple of things that don't show up on a profit and loss statement that don't really tell us so much about how our cash is flowing. So it's important to understand those differences. It also won't tell us how much money we're making. Sometimes we look at that bottom line and it's either a good number or a bad number, but it doesn't really reflect necessarily how the business is doing and answering the question, are we actually making money? So the bottom line, yes, sir.
Is an interesting point in there. And how many folks have you and I spoken to where, they have a relatively decent net, but, they're saying, but I'm broke. They have good net income on their P&L, but I'm broke. I don't have any money. I don't understand that. How can I have money, but I don't have money? Why am I paying taxes on this when I can't afford to pay the taxes? There's so much involved in these conversations.
Great comment. What you're talking about is the difference between a profit and loss and cash flow of a business. And the two things that don't show up on the profit and loss statement that impact your cash flow, the two primary things, are the distributions that an owner takes out of a practice and the principal payments on the debt. Both of those are taken out of the profit of the practice. And so you could look at a profit and loss statement and see $80,000 worth of profit, and you get a phone call from your CPA who says, hey, listen, you had a great profitable year. I need you to write a check for your taxes to the IRS. But you pull up your cell phone and you look at your bank balance and there's no cash in the bank. And you wonder, how can this be? How can I owe taxes when I don't have any money? Yep. Because the difference between a profit and loss statement and the cash flow. So I'm really glad you brought that point up. Very, very important to understand the difference. So the bottom line, Jay, is this: defining your net profitability and understanding your operational expenses. That's really what a profit and loss statement will do for us. So, Jay, you and I talk and we share ideas and things that we've seen. And, one of the things that you and I see a lot are very, very disorganized profit and loss statements. And one of the things that I try to teach is that if we organize our profit and loss statement in a way that makes sense to us, it's going to become a lot more valuable as a tool to helping us understand what the information means. And in my simple little brain, I love to break out our expenses into primarily 4 buckets. And those buckets are cost of goods sold, which is our frames and lenses and contact lenses. what I call our people expenses, which are all of our human capital. So this would be everybody that has a beating heart in the practice that we have to pay for, excluding our doctors. So this would be our non-OD compensation. Our place expenses, which are all of our occupancy expenses and our rent and our utilities. And then for simplification, I throw everything else into this giant bucket, which I call the things bucket.
I love this. This is so clean and so easy to understand.
I think it just really helps you sort of understand really where your money is going. And if you build your profit and loss categories in QuickBooks or whatever financial software you use, then I think it just makes it a lot easier to really understand. And then that last expense that we have listed here is this doctor compensation. And what's left over then becomes the profitability of the business after we've paid the doctor for the work that they've done. So this is a very simplified profit and loss format. You don't have to get this sophisticated with it. You can make it even more simplified. You can add categories. But this is sort of how we do it in my practice, which really helps us make a lot more sense of the P&L report.
You know, and I love this as a template, and I kind of giggle a little bit because, yes, you and I have probably seen more P&Ls than we could ever keep count of. But what I find most humorous about, or maybe even sad, is that when folks do have this type of definition, they do have this type of clarity, and you ask them, what's in office supplies or what's in legal accounting, and they can't answer that question. So it's almost as if people need to keep like a little guidebook that says, here's what I put under this category, and here's what I put under that category. So even if they don't go down and set up subcategories, they should at least know that, you know, maybe their gym membership was put on dues and subscriptions. I don't know. But they should keep some type of definition or explanation of the category somewhere so that they know themselves what's in those numbers. I found that when I talk with folks and I ask them about their expenses, they can't tell me why.
Yeah, you know, we're going to get into this idea of what we call owner add backs in a later video. But one of the other things that I would just say about profit and loss statements are, I know that our CPAs often encourage us to, let's just say, you know, put some expenses within our business because it does reduce our tax liability. And the IRS knows that we do that, and they're somewhat tolerant of that to some degree. But the problem when we do that is we really muddy the waters when it comes to understanding our businesses. And so while I don't like paying taxes, just like the next person, I'm to the point now where I'm really encouraging doctors, you know, your business really isn't the best tax strategy. You're making things difficult to understand when you start to bury too many expenses that are really just owner compensation within your profit and loss statement. So that when you look at that bottom line, it's not really giving you the important information that you need to know about your business. That's just my own personal opinion. I don't know if you have any thoughts about, you know, owners.
You know what, I think what you said is correct. I think that, you know, one of the perks of owning a business is that, yeah, there's a couple little things that are going to go through the business, you know, and your accountant should be keeping a good hand on staying below the radar. I'm not, you know, a big fan of doing anything that's really off the line. But, you know, what you're making me think of is a dear friend of mine who called me up and told me that he wasn't making enough money. And I said, okay, you know, let's go through your P&L. And this is probably 18 years ago. And I sat down with his P&L and I went through all these categories and I listed all the, call them fringe benefits of ownership. And when we got done listing it, it pretty much doubled the amount of income he had. And I said, the problem is you're associating your income to your paycheck and you don't even realize the expenses that you're putting through your business anymore. Yeah. I said, you know, and that's why, to what you said, cleaner is better. There's no question about that. Cleaner is easier, cleaner is better. Yeah, there's a couple little things that you're right, fall below the radar. But to whatever extent you're doing anything, you want to understand the value of it.
Yeah, absolutely. Absolutely. So one of the things I want to point out here is that on the profit and loss statement, we have some layers of sort of subcategories. In under income, for instance, we've broken down professional services and frames and lenses. And one of the reasons that we do that in my practice is that we also do that within our cost of goods. So I'm not sure you can see my pointer here, but if you see this expense 3350, by the way, the reason we put numbers in front of our categories is my chief operating officer remembers numbers better than he does names. And so if it's easier for you to know that all my revenue is in category 3000, for instance, that's simply why we put the numbers. I frequently get that question. You don't have to do the numbers. We just like it for simplicity. But just to give you an example of why breaking these down in a thoughtful manner is important is that, for instance, we calculate we separate our frame income as a sub revenue category because we want to align that with our frame expenses. And what that allows us to do is every single month we can calculate frame profitability. So now we know how much we collected relative to how much we spent, and we track this over time. We do that same with our lenses and our contact lenses, and we can run reports and then look at in great detail what our profit margin is on each of those products that we're selling within the practice.
This is so critical what you're talking about right now. So many, more than many P&Ls that I see have an income category and a cost of goods category. And it basically says income, $1 million, no explanation. Cost of goods, 300,000, no explanation. And what I try to explain to people is that's all your accountant needs. But that's not what you need to know what's going on in your business. That's what your accountant needs to understand how to file your taxes. So yeah, the accountant has what they need. But if you want to know what's going on in your business, you can't do it that way.
Yeah. You know, one of the other things that I've sort of learned, Jay, is that, you know, when we're looking at a practice from a cash flow analysis or evaluation standpoint, we often will request the tax returns because we want the tax return to align with the profit and loss statement. And the reason we do that is we want to have some peace of mind. Either they're lying to both us and the IRS, or they're being honest to both us and the IRS. If we see a discrepancy, you know, obviously that's a red flag. So the categories that the IRS asks for on the tax return are really those very broad categories like cost of good and payroll. And I think that's why a lot of CPAs and accountants have these very simplified categories, and they're not thinking about using the profit and loss statement as a tool to understand profitability, because all they want to do is know, what do I need to put in line ... on the IRS tax form.
Yeah, they're not thinking like a CFO. They're thinking the way they should be thinking as your accountant. So it's two different mindsets. I also think that you have a category here, 4,100 under rebates. And if you could talk to that a little bit, because I know we see that in two different areas. Sometimes we see it in income, sometimes we see it in cost of goods sold. You know, what are your thoughts on that?
Yeah, you know, one of my roles in addition to owning my practice is I'm a practice management consultant for Vision Source. And just like a lot of the alliance groups out there, we've got lots of advantages with rebates. And so the question is, when we get a rebate check, what is that and where does it need to get applied? Most of the rebates that we get are rebates against our cost of goods. And so what we do is we apply that as a negative number against our cost of goods. So it reduces our actual spend on cost of goods. So when we're looking at our cost of goods as a percentage of our revenue, then it gives us a little bit truer picture. Some practices will actually call those rebates income. And that's the bottom line. The math works out the same because you're adding to your income number, but your cost of goods number is overinflated. So mathematically, it's fine. In my opinion, it just doesn't give us quite the accurate measurement of what our true cost of goods are as a percentage of our revenue. Now, one thing, Jay, you pointed out to me on a conversation we had, I never thought about this in all the years I've been doing this, is, are those rebates taxable?
Yeah, completely. So that was a interesting thing that I learned a bunch of years ago when I started compensating for it myself. So you get a rebate. In many cases, you may end up even getting a 1099, right? So if that's coming in and that's recorded as income, like a 1099 would be, then it's taxable. In which case, you know, for rough math, I'll say then you should only apply 75% of the value of the rebate against your cost of goods in order to compensate for the fact that you're going to pay taxes on it. So, I know that's another gyration of what we're talking about and getting down in the weeds, but it's really understanding how money is recorded.
Yeah, yeah. And I mean, to the point of this whole conversation, which is creating these line items on this report so that you really can understand where the money's going from an expense side or where it may be coming in from a revenue side. Again, that rebate is an important one to consider. So as we move on, the things bucket is sort of our catch-all. It's got all kinds of things in it. I've seen P&Ls where they are a little bit more deliberate of carving out marketing as a separate line item expense under their operational expenses. In other words, the marketing category will maybe have advertising, printing, that sort of thing. And the point is you can make these as sophisticated as you want, but there are certain operational expenses that are pretty consistent with all businesses, and how detailed you get with this on your profit and loss statement is really up to you. You want to have enough detail so that you can look at the report and really make sense of what the expense is, but you don't want to have so much detail that it becomes overly cumbersome, because for just as many P&Ls I look at that are very abbreviated and simplified, I'll also occasionally see one that is so detailed that it really makes it hard to make sense of it as well. So there's kind of this fine line of being just detailed enough, but not so detailed that it becomes overwhelming to look at.
It shouldn't take you a day to look through your P&L and understand it.
I have a rule. If somebody gives me a P&L and I can get through it and completely recast it, meaning, tease out all the expenses that the owner has buried in that business. If I can do that in an hour, it's a pretty good P&L. If I have to make 3 or 4 phone calls or emails back to the owner for clarification, that P&L needs some work.
Yeah, agreed.
So as we continue to work our way down, one of the categories that we have is this owner compensation and an associate doctor compensation. And one of the things that I think is important is that, and we'll see this as we look through an example of a P&L, we like to record our owner's compensation and our associate doctor compensation, what we call below the line, in the line meaning below the net operating income number, because we want to see what our business does from a net operating income standpoint before we compensate our doctors. And the reason we do that is that in optometry, we've gotten very used to this optometric net idea, which is what should the practice net be before we pay our doctors. And so since that's kind of a common thing, we like to look at our owner and our associate doctor compensation after or below the line, below the net operating income. I don't know if you have an opinion on that, Jay.
I love it. What you're talking about is something very simple to do, and all it does is give great clarity. And that's what we need when we're trying to understand what's going on in our business, is to get that clarity, especially for the folks that's saying, hey, I'm just not making enough money. Well, we need the clarity to understand why. So I'm totally aligned to that.
Yeah.
By the way, and you go back for a second, I know folks sometimes get confused between a profit disbursement and understanding themselves as a W-2 employee of their own business. So I know there's a note there about being a W-2. What are your thoughts on that?
Yeah, that's a good 30-minute conversation, and one that I have frequently with owners, and that's getting them to understand that they wear 2 different hats in their practice. Hat number 1, they're an employee of their company, assuming they're an S corporation, and they're delivering services just like any other employee in the practice. The second hat that they're wearing is they are an investor in a business. In other words, they own a company, and the distributions are a return on investment as an investor in your company. And so it's important that we separate those 2 sources of income. And it's also important that we fairly compensate ourselves on the W-2 side. The IRS has very clear definition of what they consider fair market compensation, and that's essentially you should pay yourself as the owner of the business a W-2 wage that is exactly what you would pay somebody else to do the exact same job in your business. If we
Agreed.
overpay on the W-2 side, we're paying unnecessary payroll taxes, 15.3%, because we pay both employer and employee employment taxes, FICA essentially. So we don't want to overpay on the W-2 side, but we also don't want to underpay on the W-2 side, because that can get you in trouble with an audit with the IRS. So understanding you got a W-2 wage, pay yourself fair market compensation, and then you've got a distribution, which is a return on investment, because you are an investor in a company and an owner in a company that has a return. What will show up on your P&L is your W-2 compensation. Your distribution, as we talked about earlier, will not show up on your profit and loss statement.
Right. And this is going to relate, as we go into our series on EBITDA, we're going to talk about this a little bit more on how that impacts EBITDA.
All right, so let's just take a look quickly at a sort of a sample report. In this example, we have $1 million practice that's got $300,000 in cost of goods, and we've got left this number here called the gross income. I mentioned this earlier, that this term gross income essentially is what's left over after our cost of goods are paid for. And essentially just is a measure of the things that we purchase in order to resell, what's left over after that. Because what comes out of this number here, the 700 number, are all of the operating expenses of the business and our doctor compensation. Now, in this example, this is showing sort of opposite of what we just talked about, but on our P&L, this doctor compensation number will show up underneath this net operating income. But the reason that we do that, again, is this idea of this optometric net that we talked about. Jay, what should an optometric net be?
Well, I think first we should give credit where credit's due. So even though we're using the terminology optometric net, and I think, Mick, you and I could absolutely make claim to coming up with this terminology, but I think we both know we're borrowing it from a dear friend of ours, Dr. Mark Wright, who refers to the optometric net. And I've been known to borrow a few things from Mark in the past. So, but to that degree, I think the industry standard, I think every optometrist, when they graduate from school, they imprint this number of 30% net into their brain, right? So whatever they're doing, they should have a 30% net. At that time, at that moment, they're not quite sure what a 30% net really means. They only know it should be a 30% net. And Mick, I think we could both explain that 30% net is the combination of the W-2 owner doctor compensation along with the distributions that you were talking about, right? When you put them together, then you get to your 30% net. Is that correct?
That's exactly right. And in this example, the optometric net here would be a combination of what the doctor paid him or herself in compensation plus what's left over, the net operating income of the business. So the combination of these two numbers is what we would use to define the optometric net in this example. Okay, so again, it's very, very important to sort of understand the terminology and where these things all line up on the profit and loss statement. So as we continue to work our way down the P&L, there are 3 additional expenses that the IRS allows us to take as expenses against the income of the business to reduce our tax liability. And these 3 additional expenses are interest, depreciation, and amortization. So interest, the IRS says that if you borrow money and you pay interest on that borrowed money, we are allowed to deduct the interest portion of that borrowed money as we repay it back. We're allowed to apply that as an operating expense against the income of the business. So in this example, we've got $6,000 worth of interest income. We then have 2 additional expenses applied against the income to lower our taxable liability. And these 2 are depreciation and amortization. And they essentially mean the same thing with a slight little twist of the definition. The depreciation represents the loss in value of a tangible asset over time. So in other words, if I go out and buy an OCT and I spend $50,000 for it, and we decide that that OCT has a useful life of 5 years, then we would take $10,000 a year of value or of loss in the value of that instrument each year on our tax return. So the depreciation would be $10,000 a year for 5 years for this $50,000 piece of technology. So the government says, listen, you made the capital investment, it's losing value every year. We're going to allow you to take the portion of that loss against your income. Amortization is exactly the same as depreciation, but it is for non-tangible assets, things that are not, equipment or fixtures within our office, but things like goodwill or software, things that really we can't touch and feel. We're allowed to take the same loss over time and apply that as a cost against the income of our business to further lower our taxable income in the practice. Again, the depreciation and amortization are non-cash expenses. And so when we get back into the EBITDA conversation, we're going to see that we get to add this back to the business when it comes to determining what that EBITDA number is.
Makes sense, makes sense.
All right, so that wraps up sort of the conversation about profit and loss statements and what we can do to simplify them. In the next session, we're going to talk, really get deeper into this idea of what is EBITDA. We're going to define it a little bit more, provide you some sample calculations, and then most importantly, let's understand why is it important? Why would I want to track EBITDA in my practice? Why is it something that I would want to keep an eye on as I move forward?